Rates are on hold for now anyway, but it's not like families can breathe a sigh of relief yet. Inflation is still way too high. And after 10 interest rate rises, the limitations of monetary policy has somewhat been exposed. Enter the government and more specifically the May budget. What can be done on the fiscal side of the ledger now? Joining me live is Chief Economist at PwC, Amy Auster. Amy, great to see you once again. We saw this interest rate pause this week. We saw the RBA Governor's important speech yesterday. So if you were Jim Chalmers, what would be changing in your mind given those two events this week in the lead up to the budget?
I don't know about changing. I think the RBA's pause is confirming the view from the RBA and also pretty consistent with Treasury's forecasts that we saw in the October budget, that the economy is slowing, that consumption is slowing, and that these rate rises are starting to have an impact on consumers and are going to be taking the heat out of inflation. Even if we have to wait for that to happen, I think it's evidence that we are now to the point where both the government and the RBA probably pretty much expected and hoped that we would be.
Yeah, okay, so it's quite extraordinary to see an interest rate environment where we've had 10 interest rate rises, but the property market has also seen a bit of a resurgence in the face of that. Is there enough relief for renters in particular? Is that something the budget should look at?
Look, I think that's a really interesting question. So when we've started this rate rise cycle, the attention always goes to mortgage holders because they do immediately have that impact. If you have a variable rate mortgage, you're going to see that rate rise impact your bottom line immediately. Less attention on renters. But what we're seeing now is, and you just have to call it, rental crisis. The rental market is so tight. No matter where you look in the country, there are queues, there are people who are not able to get into that accommodation. And really, I think this is still kind of an outwash from the pandemic, specifically in the rental market, because as we headed into the pandemic, what happened was we closed the borders, lack of tourists, that short-term rental market, that Airbnb market really kind of collapsed. And so a lot of supply went on the market available for longer-term rental. And we had 120,000 new households form during the pandemic, even though our borders were closed, meaning people moved. And we had a reduced number of people living per house. A lot of people that meant in the rental market. Now we have tourism coming back, that short-term stay market's returning. It's really putting a lot of pressure on the rental market.
Yeah, it certainly is. The biggest problem here is housing supply. The RBA governor said that this was a key issue yesterday.
100%. So housing supply, new starts, is really very, very low, but we know that demand is there. Oddly, we're starting to see house prices start to recover. That is really due to lack of supply. So we know that, yes, new starts are very low. What developers have in their pipeline is very low. And we're seeing a lot of distress in the construction sector, which I think is partly responsible, well, largely responsible for what's happening in supply. Again, this is kind of the outwash, if you like, from the pandemic, from those supply disruptions that we saw, the increase in construction costs from materials that we saw, and those delays, which have sent a lot of construction companies to the wall. So we have some distress in that sector. It's going to take some time to fix.
So again, the budget coming up, how can the government provide targeted relief to those sectors in distress? And I'm talking about renters, those mortgage holders as well, without kind of fueling inflation even further.
Well, I think targeted relief is the way to go. And so we have a number of mechanisms that already exist to provide, if you like, that safety net into people at various levels of socioeconomic status or various levels of income. So we have those mechanisms in place. We have Family Benefit Part A, Family Benefit Part B. We have Commonwealth Rental Assistance. We have one-off forms of assistance. So there's lots of existing mechanisms, especially to target renters who are clustered in, if you like, the lower half of income earners in Australia.
Rates are getting higher. I mean, they're still historically low, but some people would be experiencing mortgage stress, as we've discussed at the moment. Renters also as well. How will most people absorb this? Are they able to, or are we going to see a lot more people defaulting on their loans?
Look, I think in Australia we have a lower risk of widespread default than they have in a lot of other countries, in the United States in particular, because of the nature of our market, because we mainly have variable interest rates, because we have non-recourse lending. Full recourse lending, meaning if you're not making your payments, then you are still liable for the rest. So I think consumers are going to be adjusting by reducing their spend elsewhere. We know households leaving the pandemic had a nice savings buffer. Some of that is still on the balance sheet, but I think the adjustment is going to come in spending in other areas. And we're starting to see that already. So reduced, obviously, holidays, reduced travel, reduced recreation, whether you cut out going to the movies, et cetera, reduced going out, and a lower spend on your grocery bill by shifting to lower cost items. So where we're going to see that shift is in spending in other areas to account for that higher increase of housing. And that is exactly what's going to take the heat out of inflation.